Good morning, everyone. Welcome to this edition of the LPL Research Market Signals podcast. My name is Mark Zabicki. I am joined today by fixed income strategist Lawrence Gillum. Lawrence, how are you doing this morning?
I'm doing well, Mark. It's a pretty volatile day in the markets, which I'm sure we'll talk about. But other than that, can't complain about too much.
Indeed, I think we could have say every day is volatile in the year 2022, at least so far. We are recording this on Tuesday, October 11th. For those who may view this video or listen to the podcast after that date, so recording Tuesday, October 11th, and we indeed have a lot to talk about. In terms of market activity, we certainly have a lot to talk about in terms of upcoming numbers this week, particularly CPI and PPI numbers, and also some, potential, Federal Reserve thinking that may be going on in Washington, D.C., specifically as folks from the IMF and World Bank gather in Washington, D.C. So before we get into that, taking a look back at the previous week in terms of market activity, last week started out fairly well for markets in general, particularly U.S. markets, based on some comments, if you will, from the United Nations that that central bankers may in fact be going too far, which likely inserted a probability that central bankers perhaps could pause. I mean, and what I mean by that is that, I think prior to that comment from the UN, I think the general thought from market participants was, the Fed is going to go full bore, et cetera, et cetera. And as we see some disjoint happening in capital markets, particularly in the UK and Europe, people inserted the probability that maybe the Federal Reserve or central bankers could in fact pause, or basically came to the notion that the probability that the central bankers pause is not in fact zero. So that's perhaps what we saw a little bit of early last week. That was followed up by some definitive downside pressure on Friday based on a better than expected jobs number, where we got, the unemployment rate in the U.S. fell from 3.7% to 3.5%. Obviously, what the Fed is doing in terms of its work is trying to impact the jobs market and take some of the tightness out of the U.S. jobs market that really has not yet quite come to pass at a sustainable level. So some modest reprieve in markets globally last week, but generally just continues to be a weak market, continues to be a market that's impacted most generally by Federal Reserve policy and the expectations around inflation. If I take a closer look at fixed income, Lawrence, this is your area of expertise, your wheelhouse, certainly. So how would you characterize fixed income markets over the last week?
Yeah, it's been a rough market, continuing with rates higher across a lot of the different Treasury yield curve tenors. But one thing I would point out is that, interestingly, the high yield bond market, so the most riskiest debt in the fixed income universe, had a positive return last year, whereas the safest fixed income markets, the Treasury index, were down a bit last week. So from my reading, it looks like this is still a rate-driven market and not a credit-driven market. So we don't see credit risks on the horizon that are kind of flashing any sort of warning signs, and that certainly showed up in performance last week anyway.
Yeah, certainly. I mean, it's about the Fed, all about the Fed, 24/7. It's seemingly, and we talked, I think, last week about the relative strength in balance sheets and much of the high yield space and the lack of refinancing need there. So maybe some of that activity was present last week. In terms of commodities, generally a space that we don't like very well. And I think we'll touch on the OPEC plus production cut, 2 million barrels a day caused a spike in oil prices and a spike in natural gas continues to be relatively strong in terms of its pricing, lifted certainly the energy portion of the commodity index and also the overall commodity index in terms of the Bloomberg benchmark. Last week, we certainly had a conversation around what was going on in the UK around the politics. Its balance sheet and what political leaders are doing in order to manage that. Some of the budgeting is going on in the UK, and some of the consternation around that caused clearly some distress in the gilt market and also for the British pound. Last week, Lawrence, turning to you on this subject, how should investors think about what went on in the UK and the gilt and the pound last week?
Yeah, and it's continuing over into this week as well. And after Liz Truss's government announced this mini budget that was going to cut the top income tax bracket for the highest earners, the bond market reacted negatively. The pound reacted negatively relative to the U.S. dollar. Thankfully, they did walk back some of that announcement last week, which did provide some sort of kind of recovery in those markets. But if we're looking at what the gilt market is doing today and yesterday, in fact, we saw another broad-based sell-off in the gilt markets where we saw 10 to 50-year maturities up 25, 30 basis points over the course of a day. So there's still stress in that market. I mean, you could argue that this is a self-inflicted wound coming out of that market, but given the rate hikes that we're seeing, globally, I think that plays into it as well. But this is an area that we continue to watch and see if there's any sort of spillover impacts into other markets.
Yeah. Certainly not helping things in terms of capital markets. What's going on in the UK? We note here German factory orders. Basically, just a message around the general weakening of Eurozone economies. Probably we would add to that distress coming out of Credit Suisse and other places, make the Eurozone not too attractive in terms of a place to put your money, given the way we think of it as a strategic and tactical asset allocation committee. So still favoring the U.S. on a relative basis versus the rest of the world. I mentioned OPEC Plus cut 2 million barrels a day. Obviously, we're not going to look at an oil price chart today, but West Texas Intermediate has in fact spiked up on that news. The Bank of Japan continues to struggle with a general weakness in the yen, and basically came out and said it was going to continue to fight that battle. And then just, I think, almost to a person in terms of Federal Reserve policymakers out there making speeches, Lawrence, they're pretty steadfast. I mean, whether it's jawboning, whether they're actually going to do the work that they say they're going to do, it's probably a little bit of both. But they're pretty steadfast on their message, are they not?
They are, and we have heard from a bevy of these Fed presidents, Fed officials over the past few weeks, frankly, since the last meeting, about their commitment to continue to raise rates until inflationary pressures come down. 75 basis points is most likely going to take place at the next meeting, particularly after that stronger than expected jobs report we saw last week. So I think, or we think that that the Fed is going to continue at its aggressive pace until they get to that 4.5% range. And maybe then they take a breath and see how their rate hikes are impacting the economy. But frankly, we don't see any sort of pivot or pause in the near term just yet.
Yeah, and indeed, the jobs report on Friday didn't help us at all. Actually, as a strategic and tactical asset allocation committee, Lawrence, I will look forward to the time where our conversations are not really driven, 80% of it by Federal Reserve policy and actual inflation expectations. So that's something clearly we've been talking about as a committee throughout 2022. Continue to talk about that. because clearly that's driving the bus at this point in time. This week is actually going to be very interesting in terms of driving that bus. We're going to get tomorrow and then on Thursday, respectively, producer price index numbers out of the U.S. and also consumer price index numbers out of the U.S. Expecting some small recession in those numbers for the most part, and we continue to expect those numbers to actually kind of come down in fits and starts, but generally trend lower. Retail sales also expected, kind of give a look into how the consumer is feeling, how their pocketbook is feeling, given any Fed impacts that may have been felt since the central bankers started to raise rates. And then clearly, University of Michigan sentiment on Friday will help us, discern that as well. That's happening out of the U.S. on the economic calendar. Turning to you, Lawrence, on another thing, FOMC minutes, and we clearly should have highlighted that orange because it certainly is going to be important in terms of the mind of the market. Any expectations from you on what we could hear or read from the Fed?
Yeah, I think it's going to be a lot of the same messages that we've been hearing over the past few weeks from Fed officials, just the need to continue to raise rate until they see some sort of sustained reduction in these consumer price increases. So I'd be surprised if the message is different in those meeting minutes than it has been, over the course of the past few weeks. As I mentioned earlier, we continue to get a lot of Fed speakers in the public these days. So I would be surprised if there's anything new in there, but you never know. I mean, every once in a while there is a surprise, and it does tend to move markets, and that's something we will certainly be paying attention to.
Yep, indeed. Looking outside of the U.S., what strikes me as interesting would be the U.K. Unemployment rate, foreign direct investment out of China, some industrial production numbers out of the Eurozone, which are always important numbers to kind of keep an eye on. CPI out of Germany and the trade balance out of China, amongst other interesting numbers, for the week. Again, trying to make an assessment of economic conditions outside of U.S. as well as we do in the U.S. So keep an eye on some of those numbers this week that should drive some activity across the pond, if you will. And as you mentioned, Lawrence, I mean, Lyle Brennard and Charles Evans were actually speaking yesterday, and Loretta Mester is actually speaking today. And that continued drumbeat of Fed officials out there getting the message out to different folks. Interesting. In Washington, D.C., where the IMF and World Bank are getting together for their annual meeting, which kicked off yesterday. I haven't seen the Global Financial Stability Report yet today or the World Economic Outlook, but two certainly flagship reports from the IMF that will be interesting for folks to digest, especially as it relates to the Global Financial Stability Report. I'm actually very curious to see what's in there and how economic thinkers at the IMF are really, digesting the monetary policy that we've seen. And then on Wednesday, FOMC minutes, as we mentioned, and Bank of Korea's policy decision as well. Any thoughts from you, Lawrence, on as dignitaries, if you will, gather in Washington, D.C., that some of the best thinkers in the world are supposed to be present? What do you think is on their mind?
Yep, for sure. I did take a look quickly at the financial stability report, and it's largely as expected. I think a lot of these global finance officials are concerned about the pace of rate hikes. Admittedly, they think the inflationary pressures are the biggest concern. So they echo the a lot of the other comments that we've heard from other Fed officials and other finance officials, that you need to continue to hike rates, but maybe not as quickly as you have in the past. I think the big concern is the fact that These rate hikes that happen in the U.S. or the U.K. or the Eurozone, they don't stay in those regions. They are, impacting global financial conditions. So the big concern out of the IMF and the World Bank continue to be focused on these emerging market regions. So there is concern about increased defaults, increased bankruptcies, just increased financial pressures on these emerging market countries based upon kind of these rate hikes that we're seeing here in the U.S. and the Eurozone and the U.K., et cetera.
Yeah. I mean, it's a little bit of a dry read, but the Global Financial Stability Report is an important one, and especially now that you see a lot of the central bank activity and the conversations around that subject. As we mentioned, PPI and CPI this week. Earnings season begins in earnest, as well as some of the major money center banks here in the U.S. and other key consumer staples companies, deliver their earnings starting this week as we kick it off. Want to kind of just pause for a moment again. As a strategic and tactical asset allocation committee, it's really all about inflation, all about the Federal Reserve. Not that we don't have conversations around other issues, because we do, but it really comes down to the trajectory of inflation and what the Federal Reserve may or may not do around inflation. So this is a pie chart simply of the CPI weights and the variables that go in the construct of U.S. CPI. This is really interesting because we're going to show in the next couple charts that housing continues to be problematic in terms of its upward pressure on inflation. But durables, non-durables, and services less housing are beginning to decelerate in terms of the month-over-month or year-over-year inflation read as we get those new monthly figures. So there's things that are going on under the headline CPI that are a little bit different, whether it's housing versus the rest of the makeup of the CPI. You can see some of that here in this chart where, non-durables looks like it's kind of rolled over. Durables is clearly rolled over. The broader CPI number is in fact the black line. Services less shelter still fairly strong, but we're going to actually look at a number that indicates it may actually be on the cusp of rolling over. Housing. Just turning to you, Lawrence, on housing. I don't know that we see. I mean, obviously, mortgage rates are having an impact on housing, and that's the expectation. But is there anything in terms of the way you think about it, about what could come from this housing variable and how it could impact Fed Reserve policy, or how capital market participants think about housing and the CPI?
Yeah, for sure. And I think it is very important to kind of break out these underlying components, because as you can see, they are moving in different directions, except for services, less shelter, and housing. Housing is kind of a catch-all category that's trying to capture rental prices and the increase of rental prices. So it's one of those categories that, I mean, if you're a homeowner and you have a 30-year fixed mortgage, that part of the inflationary prints aren't impacting you. So I think 65% of folks in this country have a mortgage or are homeowners. So a big swath of folks aren't being negatively impacted by the increase in rents. So I do wonder if the Fed is going to look through the increase in housing or the rental component there, because it isn't a broad-based category like non-durables or services less shelter. And we do know that housing that tends to be a stickier component within inflationary pressures. So we could see these elevated, CPI prints, but the actual impact of these inflationary pressures aren't as high as maybe the CPI print is showing. So I do think that they may look through that, and I think that's one of the reasons why the Fed's preferred inflationary metric is the PCE index, which doesn't have as much weight allocated towards housing.
Yeah, I mean that's a real good point, and maybe we could play Federal Reserve central banker here just for a second and begin to look at some underlying data series that may inform how we think CPI is actually going to look in the months, down the road. So I just took a look at some of these price series that are really building blocks of a CPI number. So import price index, producer price index, ISM services, business prices, same thing for manufacturing, supply chain pressure index that's put together by the Federal Reserve of New York, and what we just got done kind of talking about, CPI owners equivalent rent, which continues to be on the high side, and we'll wonder together when that in fact is actually going to roll over. But looking at the other numbers, I mean, you see in general terms, all the other price series in the indices really peaked around March and April. And there is a definitive deceleration in price pressures in all of those. So, Lawrence, the way I think about it is, I mean, we have seen some of the deceleration and inflation in the U.S. CPI year-over-year number. It hasn't been quite dramatic, but we know here there's going to be a lag in seeing some of the import prices and producer prices as they sift through into the consumer. But I mean, I would expect, based on what I'm seeing from some of these import prices, producer prices, and ISM numbers, for CPI to actually continue to decelerate, because as these other price series kind of roll over, that's likely going to continue to bleed into the CPI number. So, am I off in that thinking?
No, not at all. I agree with you as well. I mean, we are seeing improvements in these inflationary pressures across the board, absent that issue that we just talked about with owner's equivalent rent, which does tend to be a big category within that CPI inflationary metric. So if you do see consistent deceleration of these price increases across all these factors and all these different indexes, except for that owner's equivalent rent, which we know that it does tend to be stickier, because rents are contracts, and they a 12, 16-month contract, so they do tend to stay stickier. But if the inflationary pressures are decelerating across all these other indexes or other prices, maybe the Fed can say that they're getting the job done, that they're close to getting get these inflationary pressures back to that 2% target. So yeah, I think there's been broad-based improvements, and certainly this color-coded graph here is a great way to show that.
Yeah, it's certainly curious as how central bankers would perhaps look through into the variables that drive consumer prices, and some of these variables we see here have already begun to roll over. Now they're not back to where they need to be, but the directional change that we see here may be important for central bankers to take into consideration. Certainly, if we look squarely at the Federal Reserve Bank of New York supply chain pressure index, that's clearly been a big issue on a post-COVID basis. So while we don't have a whole lot of good news to report from a general level of CPI, and we'll get a fresh number this week, we are getting some good news from the building blocks of what could be a CPI number. So something to think about as we move forward in the months ahead, where we've said as an asset allocation committee that we expect the CPI to trend lower, and some of these building blocks really serve to uphold that view in terms of the way we think about it. If we move on to your wheelhouse again, Lawrence, and just in general terms, from a macro perspective, the Federal Reserve, in terms of the work it's been doing, seems to be working in terms of financial conditions, because they're certainly not what they were immediately after COVID or immediately prior to COVID. What do you think?
Yeah, for sure. The financial conditions indexes that we're showing here, there's quite a few of them, but one of them is the Chicago Fed National Financial Conditions Index. And then we also show the Bank of America Global Financial Stress Indexes. These are the way to kind of measure the the transmission mechanism of higher rate hikes into the real economy. So some of these indexes look at stock prices, bond prices, mortgage rates, things that impact I would say a normal person on a day-to-day basis. The goal is to tighten financial conditions to the point where, frankly, consumers stop spending and businesses stop hiring, and you start to see a slowdown in aggregate demand. Before you see that slowdown in aggregate demand, though, it does tend to show up in these tightening of financial conditions. And just looking at these two indexes, we've seen a pretty significant tightening of financial conditions, relative or on par, frankly, to a global financial crisis or a global pandemic. Right, so we've already seen a big move tighter in financial conditions, and the Fed. That's why one of the reasons why we think the Fed is closer to the end of this tightening cycle than the beginning, because we've already seen financial conditions tighten pretty significantly over the past 6 months, and that's certainly showing up here in the data.
Yeah, and I think the probabilities are material that the Fed has more work to do in terms of rate increases, but we're pointing these numbers out, these financial conditions readings, as well as same import prices and producer prices, just to say that, listen, the Federal Reserve, rest assured, is also looking at some of these data series, or all of these data series, and I'm sure they're taking those into consideration as well in terms of the amount of the amount of the rate increases they may engage in over the next couple months, or the duration of those rate increases. As you said, Lawrence, I think we think as a committee, we think they're closer to the end, certainly, than the beginning, and especially if we start to see a CPI rollover and the PCE rollover continue, or perhaps accelerate, then maybe the Federal Reserve takes their foot off the brake just a little bit more than markets are pricing in today. So that'll do it for this edition of Market Signals podcast. It's a pleasure to be with you, Lawrence. Thank you for joining me this week, folks. Have a good rest of your Tuesday and a good rest of the week. Thanks for joining.